Mahantesh Sabarad and chat about the fundamentals of the trading day. Mahantesh, hi afternoon. What an excellent show of resilience the market has witnessed in the last entire year. In fact, at a time when the S&P, Shanghai Composite are all in bear market territory, we've actually managed to hold through. Do you sense this outperformance and resilience would continue into the next year as well? Or do you think it's about time that we will fall prey to the global market weakness too?
No, I think we should be able to have a buoyant equity markets into the year ahead. So basically, what we are looking at is that we are looking at the markets focusing much on the macroeconomic development in India, the earnings recovery that we will have, the capex recovery that we are seeing, and currently the consumption growth. So in all these factors that you will notice that India has been resilient simply because these fundamentals have remained quite robust. And of course, we also have one more event to look forward to in 2019. Unlike 2018, we will have the Fed being a little more dovish than before. We have had 4 rate hikes in 2018. We should see only 2 rate hikes into the next year. So that should augur really well for Indian equity markets.
Soon we would be staring at earnings itself, and from about a fortnight from now, you'll have IT report its numbers first. What is it that you're making of how the IT environment has been in the quarter gone by and the kind of reversal that we've seen in the currency move? And what is it that you're hoping to hear from the IT companies this time?
So IT has been a defensive sector, as you're aware, simply because irrespective of the business growth challenges that they've been facing last year, we are seeing that currency has been a supporter, that there's much respite being offered by currency depreciation to many of the IT companies. But having said that, as we go forward, I think the single biggest commentary that we will hear from IT companies has to be on the digital side, the digital revenues driving business growth henceforth. That is what we will look at. And as far as the earnings trajectory and growth trajectory is concerned, typically you will see 2 or 3 things happening. Number one, you will have top line growth somewhere in that 6% to 8% kind of growth. You will have leverage effect, therefore margin improving, partly also because of depreciation of the rupee. Number 3, you will see most of the IT companies resume hiring in a large way so that the bench strength improves, digital revenues will start kicking in, and finally you will also see the EPS growth being faster because many of the IT companies have been repeatedly and regularly doing buybacks. That really helps the EPS growth. So from this perspective, IT therefore can become a defensive segment as we move into 2019.
Right. Okay, Mahantesh, give us your sense on what are some of the names that you'll be recommending from the broader markets for investors, stepping into the new year. What would be some of the stocks that would be on your high conviction list?
So actually we would start out right now with the consumption story, and therefore we'll pick some stocks from the consumption side, both on the FMCG as well as on the consumer durable side. Lever has been one of them. Hindustan Lever has been one of our stocks that we've been lately recommending. That is simply because there is a renewed aggression in terms of the M&A activities that they're conducting. There is ample benefit that we are seeing post the GST for FMCG companies in terms of volume growth. Rural consumption growth is quite strong, and that itself helps volume growth story. So Lever would be one of them. On the durable side, we like Crompton Greaves Consumers. Again, a beneficiary of the GST. We are seeing that the GST rates are converging, they're falling as well as converging to a lower rate. That really helps the consumption story, that helps the consumer durable kind of company. And Crompton Greaves has also been now expanding its product offerings, entering into newer markets, newer product segments. That's another company that we will like. We like at this, and in IT we would stick to names in the top 4 companies right now, although some opportunities can be had in some of the M&A led or PE led mid-cap IT companies, one of which is Hexaware.
Mahantesh, one of your notes says that loan waivers to boost consumption demand. Now, our understanding is that loan waiver is, when government announces a loan waiver, it is basically farmers who have taken loan from PSU bank. But most of the farmers are not covered by this formal channel of lending, but informal channel of lending. So, how this loan waiver would work and how it would, boost the consumption demand according to you?
So interestingly, there's also been one report here on the farm loan waiver side, and you are right to an extent that almost 56 to 60% of the borrowings by a farmer come from the formal channel, whereas the informal channel is perhaps 44%. But the interesting study that I'm alluding to is about how the farmer loan waiver helps boost expenditure. It doesn't really help in terms of improving the agricultural productivity growth, but it does help, gives an expenditure boost to a farmer and his spends on the family. So that indirectly benefits a lot of consumer companies, both on the FMCG side as well as on the durable side.
Give us, Mahantesh, give us your sense on how you would be looking at commodities right now in oil and gas in the wake of what we are seeing with oil prices and also what we are seeing with base metals.
I think we will see commodities, and it's not just oil, it will be also global metal commodities. We will see a lot of volatility now go out of the market now that Fed rates are in sync with the broader macro trajectory. That is, when you see the Fed fund rates converging towards the inflation that they want, which is around 2% and thereabouts, we would see that normalcy returning to the commodity market, less volatility, more predictability in terms of what will happen. Demand supply will typically drive the commodity prices growth, but here we will see demand not jumping as much as we had seen in the year 2018. So the supply growth will match the demand growth, and therefore we should see commodity prices generally being stable. Oil or non-oil commodities will generally be stable.
Right. Mahantesh, wanted to understand really how long do you think this entire aviation trade is going to last? Because these stocks sure have seen a recovery coinciding with the crude cool-off as well. Significant move from the October lows. But do you think there is more meat in this trade than what one has already seen?
And I think one has to be a little cautious on the aviation stocks at this juncture. It's not just because of the crude prices that is falling, which helps the businesses really perform better. It's also got to do with a large overhang of capacity that we have in our skies. So on one hand, we have oversupplies coming in from the various capacities deployed by airlines, and then we also have a situation of concentrated capacity which constrains growth in a few sectors. So it's very peculiar. Aviation, as you would know, also is dependent on other factors, which is such factors as the currency, that is the dollar rate, how rupee depreciates matters most to airline companies. It's also a function of what I mentioned in terms of capacities being deployed, and finally it's function of the yields that you are able to generate. What we know for this entire year is that yields are stubbornly low for the aviation company, and I don't think those yields are going to rise in a meaningful manner in the upcoming year, and therefore we would be quite cautious on the aviation sector right now.
Okay.
Not physical real estate, Mahantesh, but what is it that you're making of realty sector per se? Do you believe there is a contra investment opportunity here, and are you beginning now to see yellow weeds? Because our channel checks do indicate that at least commercial property is beginning to see a pickup.
See, when it comes to the realty sector, I think it's not about the sales. We don't really focus much on the top line growth for real estate companies. It's all about how they end up delivering on the bottom line, and there are problems out there. Most of these companies have poor corporate governance standards, and we are very wary of some of these companies. Real estate companies, to be frank, have never featured in our recommendation list for past several years, barring a few stray upcoming companies who tend to deliver better. So it is not scale that we are looking at. We are looking at companies who are niche in the real estate space. But like I said, very few real estate companies have featured on our list. One more thing I want to mention here is that you're gonna see interest rates rise here onwards. That is the call that we are taking, because we have seen a long period of low inflation, and the RBI actually keeping a very hawkish stance. Even if they were dovish, we think that interest rates, due to the cyclical effect, will start rising because inflation starts going up, and in such a situation real estate companies may not necessarily do well.
Mahantesh, I do want your opinion on some of the index heavyweights, the likes of an L&T or Reliance Industries. They have had their days under the sun this year, but have not delivered standout performances. What's your call on these biggies?
I think most of the index heavyweights have had problems in terms of delivering, and when I say delivery, it has got to do with the stock performance delivery. I must say here that L&T and Reliance, being top heavy kind of companies, have done relatively better to some of the other companies. I think Reliance is one of the best performing stocks for the index, or among the top 5 best performing stocks for the year, and they have managed to basically hedge their bets really well. It's Reliance, as you are aware, is no longer just an oil and gas company, not just a refining company. It's much more than that. They've got the new telecom vertical, which is buzzing. On L&T side, I think past actions on restructuring that they have done have yielded results, and they have for the first time started doing this buyback program already. My disclosure here, I own both the stocks, so I must mention that these businesses should continue to do well because of the past management actions that they've done. So on the L&T side, like I said, restructuring the business. Reliance, they're doing pretty well on the telecom side. So both should have better prospects into the year ahead.
As we speak, there's a fair amount of traction that we're seeing in Ultratech Cement. As a basket, what's your opinion on cement?
So we've been quite bullish on the cement side, cement stocks in general, simply because we have had a high growth in volumes for the sector as a whole, although pricing support has not come in. So that means for cement you require 3 things to really converge. One is high volume growth, better pricing power, and low raw material costs. In all these factors, only one factor has worked in their favor, which is volume growth. Pricing, that is yield, has not been so good for most of the cement companies, and costs have been a worry because fuel costs had been rising or remain elevated for most of the year, although right now the fuel prices have come down. As we go into the year ahead, volume growth story should still continue to remain. One of the factors should ease out in favor of them, which is on the cost side. Input cost should relatively be either stable or should fall in favor of the cement companies. Pricing may not necessarily be to their advantage as we go into the year ahead, but incrementally as we move from 2018 to 2019, I think cement will have better prospects.
Okay. Mahantesh, great to have you on the show. Thanks very much for taking the time out and chatting with us today.